Welcome back to Crypto Corner. I'm Jenny Horn, and today joined by Adam Lynch from Schwab Equity Research as we break down what is moving in the crypto market this week. Adam, let's start off with the performance of course, benchmark crypto, as we do tend to check in on the flagship, really, of the entire asset class. I mean, what are you watching right now as far as Bitcoin?
Yeah, so as of this morning, Bitcoin was up about 1.5% to 2%, trading around $95,700. It started the year at about 88K, meaning we're up about 8.5% so far year to date. Now, there have been some positive signs specific to Bitcoin lately, mostly another major purchase by Michael Saylor in MSTR. Just a couple of days ago, Strategy made its largest Bitcoin purchase since July, buying $1.25 billion worth and paying an average of about 91,500 per coin. Now, the timing of this purchase is notable, given that Bitcoin is mostly hovered in this 90 to 92,000 range so far in 2026, which means that the company was likely already standing on an unrealized loss with this most recent buy. Now, despite this, Strategy has delivered significant gains, with the company's holdings valued at more than $62 billion. The firm now has more than 687,000 Bitcoin, which is more than 3% of its circulating supply. Now, ETH is up a little bit more today, 3.5% or so, and trading around 33.20 last I looked. It's also performed better than Bitcoin year to date and is up about 11.5% since the start of the year. From a technical standpoint, both of these currencies look similar. They're both trading well above their 50-day average and are at or near their 100-day. If we start to see prices consistently above those 100-day averages, it could be another signal of another uptrend.
Yeah, so I want to shift gears to Washington. We know the Senate just unveiled an updated crypto market structure bill that would limit stablecoin rewards on idle holdings. And I mean, Coinbase already pushing back on that in real time. So why does this matter for exchanges as well as stablecoin issuers and everyday crypto users? And really, what kind of ripple effects could this have across the market?
Yeah, this will be a very interesting one to watch. So, earlier this week, and after months of bipartisan negotiations, the Senate Banking Committee and its chairman, Tim Scott, released an amended crypto market structure bill. The Senate did draw a sharp line on those stablecoin rewards, which is one of the most contentious issues in the negotiations. The bill essentially seeks to bar those digital asset providers from paying interest just for holding a stablecoin, but it would allow for activity-based rewards tied to actions like transacting, staking, providing liquidity, or posting collateral. Now, these yields for the stablecoins have been a major source of friction between banks, crypto industry. You mentioned Coinbase. So it's nice to see, some progress being made. Beyond the stablecoins, the latest draft adds a proposal which would shield software developers and infrastructure providers from being treated as financial intermediaries, simply for creating or maintaining code. Now, this was another longstanding concern from the open source developer community, who feared increased liability with this sort of stuff. One issue that does not seem to be addressed by this version is concerns about President Trump and his family's crypto ventures. Over the summer, Bloomberg estimated that the sitting president has generated about $620 million from his family's crypto business. And apparently, Democrats had aimed to add some sort of ethics provision, which in the end was left out of this current draft. Overall, though, this is a significant step which addresses some of the remaining gaps in the bill, which seeks to define how the SEC, the CFTC, and all of these other federal agencies can regulate digital asset markets. So, what comes next? Well, as the Senate Banking Committee was passing their draft this week, the Senate Agricultural Committee postponed its hearing, which was scheduled for tomorrow, with its chair citing a need for more time. These two versions, one from the Banking Committee and one from the Ag Committee, will need to be reconciled before heading to a full Senate vote. Once that's done, lawmakers will need to decide how to move forward with the House version, the Digital Asset Market Clarity Act, which was passed earlier in the summer. And then at the end, one final bill will need to go through both the House and the Senate before landing on President Trump's desk to be signed. So while the finish line may be in sight, there is still a ways to go.
Definitely, and it does feel like that's being somewhat reflected in the overall just market sentiment right now. But let's wrap with a really interesting story from New York. Former Mayor Eric Adams has been pretty vocal about crypto adoption, but at the same time, we are seeing more warnings about scams and these so-called rug pulls. So, what do you make of this, and does this change any of your enthusiasm as we, of course, watch some trends into 2026?
Yeah. First off, this is an unfortunate thing, right? Anytime we see situations like this as an industry, I think it's something that we grapple with still and something that we do need to fix. We want to touch on this topic because it's important to be clear of the risks that are associated with these things that are typically referred to as meme coins. So, like you mentioned, former New York City Mayor Eric Adams is under scrutiny after promoting a meme coin called the NYC token. The coin was pitched as a crypto project for civic causes and saw its market cap soar over $500 million in early trading, indicating massive demand from retail traders and likely some automated bots that caught the launch. The rise in the currency was swift but short, and the coin quickly plummeted in value due to liquidity concerns. On-chain data revealed that shortly after the launch, the wallet that's linked to the token's deployer removed $2.5 million in liquidity. Now, when liquidity like this is pulled from a token, leaving traders essentially unable to exit their positions without large losses, we call it a rug pull. Adams, for his part, has denied the accusations, but this is a worthwhile reminder that not everything in crypto is what it seems. Be careful, do plenty of research, and hopefully you'll be able to avoid the fate of these NYC token traders.
And I will say, definitely signaling some of these growing pains as it's still a heavily growth area of this market. So to be expected that we'll see some snags, but so appreciate it. Adam Lynch, of course, for all of that insight every week long. And thank you all for watching Crypto Corner. For more of our digital asset coverage, be sure to subscribe to the Schwab Network YouTube channel. I'm Jenny Horn. We'll see you next week.